One of the more frequently discussed dividend stocks out there right now is Abbvie, stock ticker ABBV, currently trading at $149.11 per share. Now, I think this has become a popular dividend stock pretty much for the dividend metrics alone. If we come down here, you can look at the dividend yield. You can see it's currently sitting at around 4%. And if we look at the dividend growth rates quickly, you can see the 3, 5, and 10-year dividend growth rates all looking very good, making this a very popular dividend stock. But I'm here to tell you there's a lot more to this company than simply the dividend metrics right now. In fact, a lot has happened to this company within the last year. So in this video, we are going to be digging into the dividend metrics, looking at some news, and also jumping into my stock valuation spreadsheet, which you can download on my Patreon page at the link in the description. But let's go ahead and jump into some of the most important news surrounding Abbvie stock. We can come down here and we can see Abbvie's share price has been slipping as its globally best-selling drug Humira has lost its US patent protection. Now, this is a really big deal. Humira was one of Abbvie's largest sources of revenue. If we come down here a little bit, we can see they're now having to replace over $20 billion in annual sales. That's a very big deal. If we come up here, we can see at least 8 biosimilar versions of the drug will be launched by rival companies this year. Humira sales are likely to decline by 30% year on year. If we go ahead and look at a chart, we're already starting to see some of the results of losing their Humira patent. We can see from Q2 of 2022 to Q2 of 2023, sales are already down 26% in the United States, and internationally they're down around 19.9%. So I think for me personally and for a lot of other investors right now, this is my biggest concern for this stock. Now, we can see management has promised a return to growth within 3 years thanks to some new drugs, but will that be enough to replace all the sales from Abbvie? To me, that's the big question that we need to answer. And as a result, if we look at them year to date, we can see the company is down around 8.06%, and they were trading as low as around $130 per share as of this summer. Now, there's more I want to come back and look at here on Seeking Alpha, but first let's go ahead and jump into my stock valuation spreadsheet. We'll be looking at a few different valuation models like always. And like I already mentioned, if you'd like to be able to download the spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. Okay, let's go ahead and come up here and plug in the stock ticker ABBV and hit enter, and you can see all this data will already load in. Now, let's touch on these dividend metrics just a little bit more. You can see they're currently paying out $5.70 per share, giving them a dividend yield currently sitting at around 3.82%. Now, the payout ratio is currently showing around 86.17%, so we do need to dig into that a little bit more because that's a little bit higher than I want to see it. Now, if we click on dividends and come over here to dividend safety, I'll scroll down. You can see the dividend payout ratio for the trailing 12 months with GAAP practices is showing 120.37%. But here's what's interesting. If we look at the payout ratio for the trailing 12 months with non-GAAP practices, it's showing 46.32%. Now, that's obviously a major difference between the two, and that's one of the reasons I personally don't like looking at dividend payout ratio as a result of earnings. I much prefer the free cash flow payout ratio. Earnings can easily be manipulated, messing up these payout ratios, but the cash flow payout ratio is not going to lie to you. It's really going to give you a much better idea of how safe the dividend is. For example, we can see the cash flow payout ratio for the trailing 12 months is 39.41%. That means around 39% of all the company's free cash flow is being used to pay out dividends for the trailing 12 months, and the forward-looking cash flow payout ratio showing around 51.55%. Now, the fact that cash flow payout ratio for the trailing 12 months jumps up so much when we look at the forward-looking cash flow payout ratio is actually a little bit of a concern for me, and it has to do with the fact that I think the free cash flow growth rates are going to be slowing for this company quite a bit in the future, mainly due to losing the Humira patent. So while this company has a nice starting dividend yield and a pretty good history of dividend growth, I'm concerned if they continue to grow that dividend at a high rate, this cash flow payout ratio will continue to climb higher, which is obviously not something we want to see. So that's something to keep in mind. Good dividend yield, good dividend growth rate, but definitely keep an eye on that cash flow payout ratio. Now, analysts currently have a target price of around $168.08, institutional ownership around 70.72%, and a beta of just 0.57, so you really shouldn't see a whole lot of volatility with this company. Now, let's go ahead and jump into our first valuation, and that will be Graham's valuation. Here's the formula he lays out for us to calculate intrinsic value. First, we take the earnings per share. We then get our growth rate projection, and you can see we actually have a very low growth rate projection for Abbvie, pretty much in line with analyst expectations. We multiply it by 4.4 and then divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it is sitting very high at 5.41, giving this a very low intrinsic value of $72.48. Now, keep in mind, just a few years ago, this current yield on AAA corporate bonds was sitting at around 3.5. So if that was the case, the intrinsic value would jump up quite a bit. But as of current market conditions, valuations, the current yield on AAA corporate bonds really pushing down this valuation. Now, the next valuation model we'll look at is the discounted cash flow analysis. This is one of the best ways to value a company, in my opinion, because it values it based purely on how much cash flow they're going to produce in the future. So what we need to do is project a growth rate for the future free cash flows for this company. And while they've had a pretty good free cash flow growth rate over the past few years, moving forward, analysts are actually projecting essentially no free cash flow growth moving forward, which is obviously a huge concern. But even with 0% free cash flow growth, when we take into account their cash and cash equivalents and their total debt, you can see we still come to a discounted cash flow price per share of $157.70, a little bit above that current trading price. So that's pretty interesting. They are producing a lot of free cash flow despite the low growth rate projection. Now, the next valuation we'll look at is the multiples valuation. We're basically looking at how the market is valuing companies that are similar in structure. We're taking their stock price, dividing by earnings per share to see their price to earnings multiple. Now, we actually have a wide range of PE multiples here, so I'm going to use the median PE in this scenario. We're going to take that median and multiply it by Abbvie's earnings per share, and we come to an intrinsic value of $224 per share. And the last valuation we'll look at is also one of my favorites. That's the dividend discount model. And this values a company based on how much they pay out in dividends and how much that dividend is increasing year over year. So I plugged in the quarterly dividend payouts so we can see how much they pay out each year and those year over year dividend increases, which are pretty solid at around 10.3, 10.1, 8.46, and basically 5%. So a pretty good history of dividend growth like we've already seen, average growth rate of around 8.5%. Moving forward, if we project a dividend growth rate of 4.5% and a discount rate of 8.5%, we come to a dividend discount model price per share of $154.66. Now, here's what's really important that we understand. This dividend growth rate of 4.5% is a little bit lower than what we have seen historically. And if we look at that cash flow payout ratio, I think for quite some time, a 4.5% dividend growth rate is sustainable. But if we go back and look at that discounted cash flow analysis growth rate projection for the free cash flow, we projected 0% free cash flow growth. So essentially that means they won't be able to sustain a 4.5% dividend growth rate forever. Because if your dividend increases are growing without your free cash flow growing, eventually your cash flow payout ratio would reach 100% and you won't be able to increase those dividend payments anymore, and essentially your dividend payments could actually be at risk. So again, while I do think a dividend growth rate of 4.5% is pretty sustainable for quite some time, it is something to keep in mind that if they can't grow their cash flow, then it won't be sustainable long term. But if we jump over to the output tab, we can see the four valuations that we used: grams at around 72.5, multiples at 224.39, DCF at 157, and dividend discount model at 154, we come to an intrinsic value of $152.31 a share. Now, the current trading price currently sitting at around $149.11. So with a 10% margin of safety, you could see our acceptable buy price sitting at around $137 a share, and with a 20% margin of safety, acceptable buy price of around $122 per share. So it's not quite in that buy range, and in fact, there's really only around a 2% difference between the current trading price and the intrinsic value. And again, it's easy to see why so many investors are excited about Abbvie when you look at those dividend growth rates and the better than normal starting dividend yield currently sitting at around 4%. But for me, I do have a little too much of concern about the future growth rates of this company for me to personally buy. But also keep in mind, if you look at the popular dividend ETF SCHD, which I personally own quite a bit of, if we look at the holdings for this company, we can see Abbvie is one of the top holdings. It makes up around 4.25%. So technically I do have quite a bit of exposure to Abbvie despite not directly holding it. So keep in mind, if you do own dividend ETFs, Abbvie is a pretty popular company that a lot of dividend ETFs will hold. So be sure to check that out as well. But there you go. There is a quick analysis on Abbvie stock. Go ahead and let me know what you think of this company in the comments down below. Again, like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. You can also get a discount to Seeking Alpha at my link in the description as well. So with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.